Are we in a commercial property right now? Yeah, it's pretty obvious. Is everything that we're seeing around us commercial, including the school? Yeah. Now, here comes the problem. What happens when those properties are zoned residential, and yet they're used for a commercial application? So how do you position it for the pricing, and then how do you market it? Is the marketing any differently, and what happens? Who's going to be the likely buyer? I'm going to be straightforward. The market for these kind of what I tend to call mid-cap and small-cap properties is exceedingly fragmented, so the available statistics are all across the board. So I'm going to present to you a couple series of statistics. And point blank, there are no statistics available for this, what I often call mom and pop commercial, which is what most of us are dealing with on a day in and day out basis. Mid-cap, depending on who you talk to, starts around 5 to 10 million. Or, excuse me, it goes up to give or take 5 to 10 million. So most of us aren't going to have a $10 million or $100 million shopping center in a portfolio, although there might be something there. So the issue becomes, what is or isn't a commercial? We talked about the fact that it's going to be anything mom and pop. And so where does that put Philadelphia in the marketplace? If we go out to the Urban Land Institute, which is a wonderful publication if you're interested in this kind of stuff, at the beginning of each year they rate the economy. It's actually a well-written publication. Philadelphia sits somewhere around 17 out of the whole country as far as where we are, as far as the relationship of commercial to the total population. And for emerging markets, in other words, as an investor, if you were to go downtown and buy Commerce Center for a couple $100 million, they would say Philadelphia is around 30th out of the U.S., behind places like Honolulu, Atlanta, Orlando, and so forth for growth opportunity. So what's that mean? That means they are looking at the total economy with rental rates, with financing opportunities and so forth. What's the overall economic climate? In 5 years and 10 years from now, is Commerce Center going to be as good off as they are now versus where they were? Because in commercial real estate, it's all about cash flow. And it's all about what you anticipate the cash flow to be as much as where the cash flow is today. So on the big stuff, you're not buying the cash flow today, you're buying the cash flow coming up, which is where, if anybody's in finance, anybody's dealt with this stuff, the terms cap rates, discount rates, and all those kind of things start to come up. What's your rate of return on your dollar? It's a reasonable thing if you're throwing out a couple $100 million. Okay? So the bottom line is Philadelphia is rather stable, even for big investment kind of properties. Now, is this a surprise? We all live in Philadelphia, we all see it, we all rub shoulders with business people. I mean, what's the common refrain we're hearing from people? Are people's paychecks expanding or not? So is this a surprise? So now what's it going to do to the real estate market? So we're going to talk at first real quick about a regional overview, and I'm going to stay with office properties for the time being for this discussion. Part of the problem with commercial properties is it's segmented into any number of larger, what we would oftentimes call verticals. And they could be, in a broad sense, office, industrial, warehouse, retail, special purpose, nonprofit properties, and so forth. The problem with a discussion of commercial properties is all those verticals do not walk in line simultaneously. So consequently, the projections for one of these big categories doesn't necessarily correlate to the same discussion in another category. So we're just going to talk about offices, since we all probably sit in an office at one point during the day, and we can all kind of have some kind of idea of what's going on. So on a larger level, talking about buildings that are pretty much about 40 or 50,000 square feet up to 1 million square feet, one of the sources that tracks that category of buildings is LoopNet and CoStar. So I went into their database and I said, okay, what's going on? And I put down, we have this graph here from 2006 to 2014. So you can see from this graph that before we had this decline in '09, and I put some '06 in there just to show you, around the '09 time period where we all started to run into the certain issues, you can start to see offer asking prices on a rent, where are they heading? So they drop down dramatically, and the categories are the overall state, the metro, which is the Philly area, the county, which is Philadelphia, and then the city is Philadelphia. The county and the city gets a little distorted, even though it is what it is. It's statistics. Bottom line is the trends are office rents have stabilized. And again, coming back to that emerging market that the Urban Land Institute had said, the market's stable. Well, this is no surprise. So what's this mean to America? If you have a building, if you have office space on Rising Sun Avenue, on Coppin Avenue, and you're asking $30 a square foot of rent, what are your chances of renting it? The answer is no. What's the average market going to be around here? We'll get to it, and that's where the issues are. So now, what's the average rent have to do with the projections and the well-being of the market? If the rents aren't gone up, and you want to sell your property, can you get more money for the property, or what's going to happen? It stabilizes out. If anything, it might even decline. Why? Because you got operating costs. So this is the question, and this is the issue that comes up when this is my day. So the sales trends, the number of properties that are sold, you can see at the beginning, at the end of 2013, on a larger average, or the sale price, excuse me, in this case. The sale price at the end of 2013 dipped. In the beginning of 2014, it popped up. Again, this is larger properties, and now it's starting to go back down again. This is where we start talking a little bit about the financing and what's driving everything. If everybody has been asleep, they haven't realized that the market has been going nuts in the last week or so. What's that been doing to finance and interest rates? And actually, ironically, the interest rates are doing wonderful. You can do a commercial deal at interest rates, and here's where I'll ask my expert to step in and tell me if I'm speaking wrong. The interest rates have actually gone down. Typical quoted interest rates for commercial properties are anywhere from 3.8, round number, to 5%, give or take, depending on the vertical, the specialty, the size, and so forth. Are we about right?
Yes, rates have certainly improved.
Yeah, that's a good way to put it. I love it.
I don't know if I can do a loan at 3%, but
3.8. I'm sorry, 3.8. 3.8. I've heard of apartments going that low. What's the problem now? Why aren't people getting financing? What's the issues? The value isn't holding. That's one. From a bank's perspective, though, what are the terms that they're quoting? Are they quoting traditional banks? Let's stay away from hard money, CMBAs and all that, commercial mortgage-backed securities and all that. We got an expert in here for conventional. So on a conventional side, are you giving non-recourse loans?
no.
What's that mean? Anybody know? Go ahead, please.
Well, if you borrow the money, you have to pay it back, regardless of whether the property is worth it or not.
That's a recourse loan. And that is what everybody's doing. In 2009 were investors doing those kind of loans. Were banks able to give recourse loans where they said, if it falls apart, give it back to me? Yeah, they were doing that. That was typical industry standard, which is what was driving the bubble. In part, there were other favorable things. But in part, investors had very little risk. Again, my expert, am I reflecting this fairly accurately? Okay, this is even traditional banks doing this, let alone the CMBSs, the commercial mortgage-backed securities, and the hard money players. Hard money is kneecap collateral. There again, you don't have a contract per se, but you pay back the loan, otherwise you know what's going to happen. And there's a lot of private money out there. There's more than you think there is. And actually, that's what's driving the market right now is the private money. Because all the deals I'm doing under $5 million are in some fashion driven. They're not 100%, but there's a high percentage that are coming out of essentially the bond monies, the bond funds and the stock markets where people are getting skitsy and they're placing it into real estate. That is oftentimes what is referred to in a large bucket as hard money. The only question there becomes, is that hard money coming from a corporation or is it coming from Cousin Vito? And then at that point, then the risk aspect changes dramatically. And you have to be aware of it. So what are some of the other things that are affecting the conditions of where this tail is likely to go at the end of 2014? The mortgage terms are being quoted on a 30-year amortization with a 5-year call, 10-year if you're lucky. So what's that mean? Again, am I correct?
Yes.
Okay, so by and large, what does that mean, guys? In 5 years, if you borrow $1 million, what does the bank want? $1 million. Now, if rental rates and all these other things, the economy are stable, if you don't have your building operating at 100% or close to it and get enough to pay off that debt service of $1 million, what happens in 5 years?
Bank call loan.
Bank calls the loan, and who's responsible for the $1 million?
Borrower.
It's a recourseable loan, not a non-recourseable. So you're responsible. So people are saying, what am I doing? Okay, they may or may not actually be able to verbalize it, but that is what's happening. Am I pretty much hitting it? So what the dichotomy in today's market is that the interest rates are exceedingly favorable. They're probably the best they've been even before the bubble in 2009. But, you know, the bottom line is people don't really care if I have to pay a 5 or a 6%. Interest rates back then for a typical deal were much higher than they are now. I don't know how many basis points higher, but they were higher. The interest rates right now are probably the lowest they've been in years. But that's not what's really driving the commercial market and the willingness to borrow money. It's all these other terms. And that's what we're running into in this mid-cap and small-cap market, Main Street USA. And that's what's driving it. So am I covering it in a very broad brushstroke pretty accurately here? My financial expert?
I think you are.
Okay. And so on my side, as an example, I've just closed out, I don't know, probably $3 million worth of deals in the last 30 days. Probably a full 80% of that was done in part by seller financing. And the sellers were giving anywhere from 5 to 6% interest, 30-year AMs, 5 to 7 year calls. But they're absorbing, essentially, they're becoming the bank, and that's how the deals are being done. Even this residential portfolio that I was talking about, I sold it out at $1 million. 50% of that was given out of seller financing. And then there was a second, the deal was broken in part so that traditional financing was obtained on half of it, 80% of half of it, and then the other 50% was given off of the seller finance. The deal wouldn't have worked. I just sold a 60,000 square foot warehouse, a loft building type of thing down in North Philly, and the seller, who was and still operates as a bond, which is a CMBA out of Illinois, they gave 80% financing on it. Again, at around 7% interest for a 5-year call. So we're getting all those kind of deals that are happening. So what's that do to the price of properties? And that's the question. Questions? I'm throwing out a lot. Am I hitting the right topics here? Is this what you guys want to hear? Okay.
This is great. Tell me about occupancy. What are the
I think we have a slide on this. So this is the number. So let me get to that real quick. What I'm going to do is I'm going to burn through this. So the bottom line is on the regional properties, on the big stuff, there's a lot of vacancies. You know, you go into Jenkintown, you go into
20%, 40%.
I've actually run through some numbers, and on warehouse buildings in particular, the most recent that I've seen, it's Philadelphia is at the top of a lot of markets, and they're at about 22%.
Vacancy.
Yeah. Now, depending on the sub-market in Philly, and this is where the fragmentation comes, vacancies over in Plymouth Meeting in the main line for office, retail, and so forth are probably the lowest in the region. They're probably down around 5 to 6%. You come over here into Northeast Philly, and it's a completely different game. And again, it becomes, when you ask me for vacancies, I'd have to know specifically the vertical that we're talking about.
So Northeast Philadelphia and Abington, Jenkintown.
They're struggling. They're struggling. There's particularly, let's camp on the office market, just because I don't want to distort and blend everything. Again, it gets really nasty. Jenkintown, Abington, I'm listing some stuff right along Old York Road. It doesn't have parking available to it, so consequently, I can't get rid of it. So what are the typical terms I'm having to quote? $11 gross, or a modified gross, meaning that ownership
With
will...
parking.
Huh?
Have it with parking. All
With parking, I could get rid of it at around $15 a square. Right now, without the parking, I can't get rid of it at $11 a square. So I've had 4 or 5 people that have really shown interest, and then they've walked because of that. So, and that's ownership paying real estate taxes, insurance, and all that is what is referred to as a modified net, or modified gross, depending on which side they can't be. So, all these things, the bottom line is there's enough available where people have options. And that is the name of the game, isn't it? It's replacement. And again, you guys that are, you're presidents, you're involved in corporations, you know what I'm talking about. I mean, is this a surprise? Okay, so does that answer the question? So what's happening is, we have asking rents, I don't know how to sign. Okay, so let's flip the conversation to Main Street USA. We were talking just a moment about larger properties. Main Street USA is these larger or these smaller properties up and down the street. Okay, so in order to drill down a little bit on that, I went to another database. I went to Trend, which arguably is not the best database for Main Street USA. But then again, there is no database for Main Street USA. People don't track it. They don't track by neighborhood. So the data occupancy and vacancy in West Philly is a completely different animal than it is over here. Okay? But in general, based on Trend, again, out of Philadelphia County, we can see the number of units listed, commercial properties listed, has declined precipitously. In the burbs, it's been fairly stable. So what's that mean? Well, supply-demand. So again, on the average dollar listing, we can go in and we can look at Philadelphia. The average dollar listing, it's blipped up a bit. In the counties, it's blipped up. So this is what people are asking for. Then the average dollar sold. You can see the trend. So there's the difference between, the real key is the dollars, what it's sold for on a square foot basis. It's all going down. And then, I thought I had a slide in here. The delta between the average listed and the average sold. What is happening since 2009 is there is a major schism between what people think something is worth, what the market thinks it's worth. And that delta is really critical. So from my perspective, when I go out as a listing agent and I'm talking to an owner and I say, what do you want to sell the property for? And they tell me $1 million, I look at the set of data and I'm like, this ain't selling for any more than 500. How do I convince somebody? And the answer is I'm never going to convince a business owner. They just have to figure it out. Or how do I perform? So when I tell them it's only worth $500,000, they want to list it for $1 million, do they even list it? The answer is a lot of people don't. So these numbers on this local market get really skewed. So the difference between expectations is critical right now. Okay, what you think it's worth, what you think it's worth as a seller versus what a buyer will pay for it is a completely different animal. Anybody been there? Anybody have something that they've listed lately and they say it's worth $1 million and the agent comes in and says here goes an offer for $300,000?
We haven't listed anything recently. My husband and I own his office building at 7909 Bustleton. And we were looking at doing a refi. And we actually are running into an issue because there are no comps. Nothing else has sold in that several block stretch.
Right.
And that's a challenge.
Well, it's not. You can then go back to the income approach and throw some cash flow against it and stabilize it out.
Right.
Pull a rate of return off of that and say this is where it probably will go. So you may not like the answer though.
That's a good.
Chances are you will not like the answer.
Joe, the thing that I've been facing is, say in your situation, looking at a refi,
Right.
is the, call it, significant adjustment in appraised values.
Right.
I just have a customer of 11 years who we provided the construction financing for his building. At that time, it was appraised at $2.2 million.
Right.
So we're doing a refi, and I was asked, should this be should value be a problem? I says, no, even if it dips 10%, we're going to get a $2 million value. Well, it came in at, the overall appraisal adjustment went down. It's 20% adjustment, so it came in at $1.8 million.
Right.
He wasn't too happy. And I went back to our appraisal group to say,
Right.
can you take a second look at this thing? And they came back and said, a 20% reduction is not surprising.
Okay.
This is the things we're facing.
Got it.
Yeah, so play this out. Why was that being reappraised? From a banking perspective, what triggered that to you?
It's the last time it was appraised was 2005. So
Okay.
now in doing a refinance and providing new money, you have to know that you have good collateral support, a good loan of value.
Your bank is, well, all the banking institutions are held to market as well. So is anybody familiar with that term? Sarbanes-Oxley, this is back from the 2009 debacle. The federal government stepped in and now they're enforcing, from an accounting procedure, mark to market. So if a bank owns collateral in a real estate that was appraised at 2.2, what are they obligated to do at certain points now?
Make sure it's still right 2.2.
Correct. Why? Because that's what the book says it's worth, and that's collateral to that. It's accounting. So they are obligated, and from the larger perspective, all banks, depending on their charter, are allowed to loan a certain portion of the portfolio, and then it gets really intricate, and I can't even get there. But different banks have different charters that allow them to do certain things. So they have to have a certain amount of money in reserve. Again, am I hitting this in a simple form? So if in fact they say they have collateral at 2.2 in a real estate, and they don't, what's that mean to their lending ability on the back end in other areas? They can't do it because the ratios are not there. So it's the liquidation ratios as they often refer to it. So what has happened is all these banks are required to get new appraisals. At this point, it's pretty much annual, isn't it? At a certain level.
No, yeah, you could
Or can you
request appraisals, I think, every 3 years.
Is it every 3 years? So every 3 years, the bank has to, at a certain price point, get an appraisal to support their assets and restabilize out their book value.
Client pays for that extra appraisal?
Yeah,
Yes.
bank doesn't do it. And actually, it turns out that most of these banks have termination clauses in them. They were smart enough, even with a non-recourse, that if in fact the asset value declines substantially, they have the right to call it immediately. And this is what's happened. This is continuing to happen, and some would say it's not over with. A lot of people would say it's not over with. So that's, again, am I reflecting this accurately?
You are.
Okay.
Yeah, you had a lot of, I think years 2009, 2010, 2011, there's a lot of loans that were done prior to those years. If they were 5-year loans, the values at that time when they were done were more or less called, inflated somewhat, and then you had a market adjustment in the values. And when these loans came due for maturity, they were being reappraised for refinancing, and the values weren't there. So a lot of properties were underwater, and it caused a lot of commercial property owners to dip into their own pockets to bring the bank in line with the LTVs that were required, if they could do it.
If they could do it. And we're still running into that. Again, pressure on property owners and buyers as far as what am I going to pay for this? So this, what I'm trying to come back to is why is Philadelphia identified as a stable market? We live in it, we all see it. I'm trying to give you guys some thoughts as to put the legs on what is this about. Hopefully I'm doing a good job trying to cover a lot of territory. Please.
Talk about retail space. A few years ago, you couldn't walk down a street in America, and every third storefront was empty. Has
Right.
that improved now?
Again, it depends on the submarket.
Town, Abington, Wilgrove.
Well, The occupancy levels of a lot of the storefronts and a lot of the retail corridors has in fact increased, or decreased, or yes, increased. The vacancy levels have gone down. At what cost? The cost is the fact that you no longer have franchise or banner businesses in there. You have dollar stores. You have alternate stores. For that matter, they're putting offices into the retail center. So they're doing anything possible to keep occupancy. But at what cost? And so consequently, you go from an anchored A credit retail center down to, if you're lucky, a B credit, which means how do you get your financing?
Can I tell you a quick story?
Please. That's
So
what
in
we're doing.
1979, I was opening a real estate office on Castor Avenue. On Castor Avenue, from Bell's Corner to the Boulevard, there were 2 vacancies.
Right.
I had my choice, take it or leave it.
Yeah.
Okay, so I rented a space with 800 feet for $700 a month. No build-outs. That means it was 4 square walls, you had to put everything in yourself. $700 a month, 1979. 2012, I had a franchise with a bank in Quakertown.
Right.
And they decided they wanted to do it themselves. So I had to open my own office to handle all the clients that I have in the bank.
Right.
So I opened an office 670 square feet, not quite as big, and not on the main street, but sort of like around the corner. Okay? It gets better. $525 a month. Okay? 5-year lease, both were 5-year leases. The only difference is this included utilities.
Right.
The build-outs were already done, and they put a clause in the lease that if I wanted to get out of the lease, I gave them 60 days notice to get out of the lease.
Right.
Okay, this is 30 years later. So if somebody says, you always make money in commercial real estate, tell them that story.
Yeah, and this is what's, you guys asked me to give you the skinny on the commercial market, and I'm giving you the skinny. So it is not for the faint of heart, and you really need some good professionals to back you up, whether it's the agency side or whether it's the finance side or the insurance. There's all kinds of issues. So,
Joe, in the last
I'm sorry.
2 minutes, you were going to mention the nonprofit.
I'm getting right there. I'm trying to move on. So I'm trying to run like heck here. So
You're doing great, and we appreciate it.
just so you get an idea of my background, photos of churches, schools, nonprofits. The only thing in common is my partner, our boutique firm, has represented all these, probably in the last 48 months. So everything from 48-acre camps to the church buildings to cemeteries to whatever. So what is the big issues of nonprofits? The bottom line is there are nonprofits out there that own real estate. There is a perception that that real estate is not saleable. False. The issues really become one of what is the underlying zoning. If I have a church building, if I have a nonprofit and it's zoned residential, what are the chances of me getting a variance to put in offices there? I don't care what township and municipality I'm in. You got to have a lot of money, and it's got to be worth it, sort of like down in the Templetown area or in the center city, where the churches are in fact being bought for conversion to retail. Very rarely do they get the variances for the office, though. They want to keep it low density. So you still have to have about $50,000 to $100,000 to get all the permits done and all that. There's got to be enough money in there. These are multi-million-dollar deals. For the nonprofits up in these areas, you're not going to get those numbers. So the issue becomes one of what can you do with it? And then from a buyer side, if I'm going to get a buyer to pay a premium for the property, everything has to line up identically. So we oftentimes refer to it as level 1, 2, 3, and somewhere else buyers. So our job is to figure out, are there buyers out there that can use the space? We just did a deal probably 48 months ago right up the street on a retail center. It was a medical office space, and it had all these medical fit-outs. We could not get anybody from a retail side to move in there. We did find a temple, a Hindu temple. They moved in, I'm sure. Yeah, so we were the agents on that. So we moved the Hindu temple in, who had enough money and enough resources to do their own TIs, convinced ownership that it wasn't worth it, just unloaded as a shell. And then some. Why? Because the buyer has to pay for the tenant fit-outs. They have to go in there with the dumpster and get the permits and do all the gut. And that costs money, which is where you're coming from. So the issue becomes one of, on a nonprofit, how do you find a buyer that slides into your building that was your building built for your denomination, your specific need? It's not often easy. So level one, you got to keep in mind the supply-demand type of thing. So level one, level two, level three. Think of it that way. And the other thing comes into the idea is, for nonprofits, a big issue becomes pricing it right up front. Why? If I put a church on the market or a school or whatever on the market at $1 million and it's only worth $400,000, what have I basically told the market?
You don't want to sell.
I don't want to sell it. I just want to throw it out there. This is the same as residential. The problem is on the commercial, everything is extended by 3 months. Think about just the financing. How quick can I crank a finance deal for a commercial property? How quick, if I came to you with an ideal buyer, could you do a deal?
So let's say a very good credit, very good buyer, good credit, probably get an approval within, say, 3 weeks, and then you're taking a look at doing the appraisal, which takes 4 weeks. You got to do an environmental, which is done 4 weeks for an appraisal.
Yep.
You got to do an environmental study, which is done sooner than the appraisal, so it's done during the same time. And then if you're utilizing outside counsel to document the loan, it could be another 2 weeks. So you're talking, could be like a 3-month.
Okay, and that's assuming that I found the ideal buyer and everything's lined up and all that. On a residential deal, how quick can I get financing?
My daughter got one in 3 weeks.
Okay, here's the difference. So if I overprice the property and I basically tell the market, I don't want you to be buying this anyway, after 6 months when somebody finally gets in their mind, I'm out of cash flow and I need to sell this thing, I then have to go back and reinvigorate the market. Then when I find the ideal buyer, I'm still out 3 months. And you as the nonprofit are still having a burn rate on your cash flow of how many thousands of dollars a month. It doesn't look pretty and it doesn't get pretty. And that's the problem we have with the nonprofits, and also really in commercial real estate. People lose track of the fact that everything's extended by multiples of 4 and 5. So I rarely get to a close within 6 months. So it's just the nature of the beast, and that's why I run with anywhere from 15 to 30 listings. It depends on the time of the day, because I got to run 4 and 5 deals simultaneously, and that's the way I make it work. So the issue becomes one of, and here comes another problem that people don't think of. Think of this like a car. If you go out, I always tease people, I love Subarus, and part of it is the price is right. But if I go to a dealership and they say, I'll sell you that Forester for $50,000, you know, a typical Forester is, what, 20 to 30, round numbers, depending on your add-ons. Well, I go back to that dealership. I probably won't. I'll walk away. And if I then am asked to go back to the dealership and they said, I'll give it to you at the right price, what am I naturally going to do? Am I going to pay them the market rate for that Forester, or what am I going to be as a business person? I'm going to say, give it to me for 10% lower and then I'll come back to you. What makes us think real estate isn't the same thing? It's a commodity. So when I overprice a property and then I finally get real and I say, let's sell it, what do I really have to do in order to make that market come back to that property? I drop it below the numbers. Now in another 6 months afterwards, the market's forgot about it, and I can pull it back up to conceivably the appraised value and maybe get a sale out of it. But the bottom line is as a nonprofit, can I hold on to it for 12 months? I'm already 6 months before I come to the realization. I'm out for another 6 months for it to settle back in. Your burn rate is what, $10,000 to $30,000 a month just to hold the property? What have I gained? And this is the conversation. And it goes on and it goes on and it goes on. Anybody in nonprofits experience this? Or am I blowing smoke on this?
Well, this happened at Second Adult Camp in Melrose, Israel. So it was on the market for, I don't know, a couple of years.
Right.
Finally, they found a kidney dialysis center.
Right.
But it just went on and on and on.
Yeah, I've had a couple people make offers on that one. So, yeah. So there they, in some respects, did well by holding on because they got the zoning variance. But it took them 2 years to find somebody, and then the price had to be low enough. So there's all kinds of signage issues and It's Cheltenham Township, another world. I've got a church right now over at Oak Lane, and Oak Lane is for sale over in Cheltenham, not far from that. So you want a church? I got one to sell right now. I've got 3 of them, so it depends on where you want. So there's all kinds of issues, and these things have to be kept in mind. So the issue is pricing it right, yada, yada, yada. How you do a deal on nonprofits is the same you do a deal as for-profits. So the key to nonprofits is identifying who the decision makers are. Oftentimes, the president of the nonprofit doesn't even know the right process. If you're part of a nonprofit, I would encourage you to break out your corporate documents, which is often the governing documents that need to be presented at closing. Make sure who can sign off. Believe it or not, sometimes it's the treasurer who needs to sign off as opposed to the president, because they're the ones that theoretically control the books. Does it require how many people? What is the decision-making process? And it's really not all the same. Anybody here part of boards? I'm sure almost everybody is a board member of something. And you can imagine. So the issue becomes one of, on nonprofits, identifying who the decision maker is. We run into situations where somebody says to the decision maker, we say, give me the corporate docs as part of the title search, because they need to be presented to the title and the closing conveyancer. And then all of a sudden we find out that they're not even the decision maker. So clearing the stipulations and getting the close is really a treat. So we're out of time.
Yes.
Joe, I was going to ask you a quick question. You and I touched on this on the phone. Could you share with us your thoughts on, between the school district and the Archdiocese, a lot of vacant properties that are being resold at a fraction of the cost? Any thoughts on that? And do you represent, have you handled any of those?
We have handled 1 or 2, and by and large, our clients tend to be outside of the Archdiocese for whatever reason. We represent the Presbytery USA, we represent the United Church of Christ, Southern Baptists, and so forth. And we're happy with that. The Archdiocese stuff is fraught with problems. Where are the problems? The Archdiocese issues are so tough, because there's such a big gorilla, they hire appraisers to go out, peg a number for the property value, and then tell the broker to list it at that number. And then when the market speaks, oftentimes it's nowhere near it. So what happens is there's a maturity of 6 months, 2 years, whatever, and I can't function that way. I'm much better going straight in, head to head. It's the kind of person I am. You've got to know your personality. So where the problem of the Archdiocese is coming from is that. The other issue of the Archdiocese is the buildings, by and large, are too large for the market's use. So most of the cathedrals, as an example, seat 500, 700, and there aren't congregations that are big enough to support it. Other problems that come up is by virtue of their building style, they put the roofs up 40 and 50 feet. How do you fix the roof? What is the cost of fixing a roof that's 40 feet up?
I belong to that Shalom.
Okay. So I'm talking the same stuff. Right. So when a congregation buys that building, they have to maintain that and get somebody up there. So the roof costs, the maintenance costs on these buildings are just egregious. Bottom line is, most of the time these buildings are worth land value alone. Less what? Less the demo cost. So where's the value? There isn't. Give it to me for $1 and I'll take it over. And the problem is the seller has it in their mind that it's worth more. So that's a broad idea of where this is going. Yeah, we deal with this all the time. I can't sell buildings that seat 500 and 600 people. We list them, but we don't sell them.
The Archdiocese had no trouble selling their property in Denver.
Yeah, they do have trouble.
Right now.
Yeah, well, only those that are redevelopable. But there's several that are not.
Each block had no problem.
There's several that are not. But I'm saying to you, if in fact it's a church and stay a church, there are problems. Yeah. You're asking me, and I'm saying that's
No,
what
I'm
this
talking
is.
about a big house they had they used for.
Yeah, the rectory. Yeah, the manse or the rectory. Different
It
animal.
was a block from the beach.
Yeah, the block from the beach is fine. It's a different animal. Under all is the land value. That's the name of the game. Yeah.
take 30 seconds to touch up on residential if you can?
I'm sorry?
Residential, like in 30 seconds?
I don't sell houses. I just sell them in bulk.
Or you do commercial?
Yeah.
To talk about residential. That's a good idea.
So, okay.